The S&P 500 hitting a new record today. Some investors apparently encouraged that the U.S. has reached that trade framework with China and that trade deals are in the works between the U.S. and other partners. Let's get perspective on this stock rally from Chad Morganlander, Senior Portfolio Manager at Washington Crossing Advisors. Chad, thank you very much for joining us.
Thanks for having me, Andrew.
So the market finally getting above that February 19th high. Do you think it would be bad news if it can't hold this level, if the S&P drifted down from here?
Well, if you have a modest retracement from these gains, that wouldn't be that bad. In fact, that may be healthy. There's a little bit more speculative froth in the market as we see the headlines come rolling in. There has been economic soft data that here in the United States has decelerated. And the big question is, will that be long lasting?
We get this debate between value stocks that may be expensive, but the business, that are often cheaper, higher dividend yield, maybe slower growth, or the growth stocks, which are the glamorous ones where profit and revenue are expanding. But you think that misses an important quality in equities? Can you explain?
Yeah, typically value stocks, they have a lot more debt, lower returns on investment, and they may also have decelerating revenue lines. Where you get, where one wants to do is look for quality in this type of market. Companies that have more consistent cash flow, durable, predictable cash flow, very low debt, and rising dividends. We think that there's a seam of opportunity there because those companies have been underperforming in this latest market rally.
Is the market just looking for go-go growth stories right now?
It seems that way. There's more of the higher momentum names that they're looking for, companies that are AI related and regarding to Tesla, for example. They're looking out in regard to cash flows and growth 5, 10, 15 years out to justify valuations. There are some blue chip companies within the quality technology side that do actually have reasonable valuations where you don't need to put a high expectation out there for year 10 to make the math work.
And tell us, just returning to these quality stocks, you say many people assume that they'll do better in a market downturn, but most fail to grasp the speed of this nonlinear effect. What do you mean by that?
Well, what happens here is typically that when you get a market that it starts to actually unravel. And this happened, remember, a couple of months back before the big bounce here. It happens with companies that are lower quality, the companies that have higher debt burdens on their balance sheet. The stock prices start to act and behave like a stock option. You want to be mindful of that when putting together a portfolio. We not only look at the companies based off of the valuation of the market multiple, but also look at the balance sheet quality of those individual companies. And what we find is that many investors get caught blindsided in those market dislocations where they buy companies that they think are cheap with low PE multiples. But as you start to see this unraveling, those companies are the ones that are most volatile on that downside. So we just want to be somewhat more measured and circumspect about what we put in a portfolio.
You have a couple of stock ideas for us. Start off with Oracle. What's the attraction here?
Yeah, so just for full disclosure, I own it personally. This company, we think, is one of the safer ways of playing the artificial intelligence wave. They are a hyperscaler. They're going to be the one that's going to be hosting many corporate data and back office structures. So what effectively this means is that it's going to be a subscription-based business model. over the long run. They're going to benefit from not only hosting the LLM model companies, but also the inference side of it. When one asks a question to their AI chatbot, they're the ones that are going to be serving up the answer based off their host, them being the hosting center. So this is going to have a long tail to it. We think it's going to be quite exciting. And again, you get a company at a reasonable price with growth expectations around 10% or 8% to make the math work. We would be a buyer of this over the next 3 to 5 years.
And finally, Microsoft is in this duel with NVIDIA for who's the most valuable company, but you do see upside in Microsoft.
Yeah, we've owned Microsoft for over a decade. Similar to Oracle, we're trying to play this in a high quality way, a company that doesn't have a lot of debt on their balance sheet. We think that they've diversified themselves quite a bit. They'll be able to monetize the hyperscaler side of the business with their Azure database and Azure hosting centers. So again, to justify the valuation, you need revenues to grow roughly 10 to 11%. This is a rising dividend kind of company with a very durable balance sheet. So those two would be two that we would put into the portfolio. And we think that you can get some handsome returns over the next 5 years.
And we'll squeeze in one more idea. Elevance Health, ELV, what's the attraction there?
So the HMOs here in the United States have really taken quite a beating. Elevance Health is one of the largest healthcare providers. They have come on a little bit of hard times, but we think it's temporal in nature, meaning that their participants have been putting in for more healthcare claims that were well above what expectations were. This is still a growing, profitable, well-capitalized company that has a rising dividend stream. We think that those claims from the cohort will roll off over the course of the next 12 to 18 months, giving them a better earnings outlook 24 months from now. We think valuation-wise, you're getting a very high-quality company at a historically low PE multiple.